If you are a value investor or just in search of some cheap stocks, there may not be a better sector to look at other than real estate or REITs. There are plenty of investors that are misinformed about REITs and how they work. Many view REITs as just an income play. Trust me, REITs are much more than a bond-like investment. Yes, they tend to have higher dividend yields due to the fact that they must distribute more than 90% or at least 90% of their taxable income back to shareholders in the form of dividends. Higher rates have driven the share prices of REITs way down, and there are plenty of high-quality REITs still trading at significant discounts. Interest rates and the hiking cycle the Federal Reserve has taken us on over the past 12 to 18 months appears to be coming to an end, and this will bode well for REITs. What this means is you can add some high-quality REITs to your portfolio at bottom feeder prices. Today, we are going to look at two insanely cheap REITs, but we are also going to look at a REIT that I have warned investors about and a REIT that I will not own. So one REIT to avoid, two REITs that look very cheap and I would buy. So if you're excited for this video and love REITs, do me a huge favor. Smash that like button down below. Subscribe to the channel so you're notified anytime we drop new content, and let's jump into it. Hey everyone, Mark Rusin here, back for another video. As always, I'm a CPA and not a financial advisor, so please perform your own due diligence and do not take this as financial advice. And before we begin, let me take a quick moment to thank today's sponsor, which is The Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all levels. And right now, if you go to fool.com/Mark, you could sign up to receive their 10 best stocks to buy right now. Now getting back to the video, and if you're an investor that's looking more for not just to rely on Social Security in retirement, or if you're looking for passive income that will eventually cover expenses, then you're going to love dividend stocks, and REITs are a type of dividend stock. So we're going to start off and take a look at two insanely cheap REITs that I like, and then lastly, we'll look at one REIT to avoid. Let's begin with REIT number one, which is American Tower, stock ticker AMT. American Tower is the premier cell tower REIT, so technically they are a technology REIT. And this day and age, everything is connected to data. Whether it's using your cell phone or making an online order, whatever it may be, the importance of data and connectivity is only growing in terms of importance. As such, there will continue to be a demand for cell towers. And American Tower, being the premier cell tower, is the cell tower REIT that I want to own. Now, I know there's going to be some comments down below talking about satellites and how they're taking some market share. That area is still very small. But if you want to make the argument that that may be a good growth area to invest in for the long term, there's going to be a lot of ebbs and flows with it, a lot of volatility, then that's a solid argument. But to tell me that it's going to take over and cell tower REITs are going to be obsolete, that's a different story. Again, American Tower is the premier cell tower REIT. They have a market cap of $87 billion, and over the past 12 months, the stock is down 34%. How's that for value hunting? The company recently reported their Q2 earnings that saw revenues grow 4.5%, which was 6.3% when you take out the foreign exchange effects. Tenant billings grew by 7.2% year over year. The best performing region was Africa, which saw organic tenant billings growth of nearly 13%. During the quarter, American Tower Management increased their full 2023 revenue guidance from $10.76 billion to now expecting $10.88 billion on the year. They also raised their EBITDA targets, billings, and AFFO guidance as well. Management now expects to end the year generating AFFO of $9.70 per share. You get a global presence when you invest in American Tower, as they have nearly 226,000 communication sites across the globe. American Tower pays an annual dividend of $6.28 per share, which equates to a dividend yield of 3.4%. They have increased the dividend for 11 consecutive years and counting, and have a 5-year dividend growth rate of 13.3%, which is quite high for a REIT. Analysts are calling for 2023 AFFO of $9.73 per share, which is about in line with management's expectations as well. and they expect $10.52 per share in 2024, which equates to a forward price to AFFO multiple of 19 times in 2023 and 17.6 times in 2024. These figures are well below the company's 5-year average of 25 times, making the REIT look extremely cheap at current levels. Analysts agree as they rate the stock a strong buy and have a 12-month average price target of $234 per share, implying 26% upside from current levels. REIT to own number 2 is Alexandria Real Estate, stock ticker ARE. Alexandria Real Estate is another REIT that I like a lot. Alexandria Real Estate is a REIT that I own a little bit of, and Alexandria Real Estate is a REIT that's trading at a very cheap level. Alexandria Real Estate has a market cap of $20 billion, and over the past 12 months, shares of ARE are down over 30%. So what's going on with Alexandria Real Estate? Well, first and foremost, they are labeled or grouped as an office REIT, and Alexandria is anything except a traditional office REIT. As you may be aware, office REITs have been getting crushed as more and more employers have moved to at least a flexible work arrangement, which has resulted in a need for much less office space. This doesn't mean that office space is going obsolete, it just means there's less of a demand. However, Alexandria is not your typical office REIT. The company owns, operates, and develops life science properties and campuses. In addition to being labeled as an office REIT, which has really put the stock under pressure as the group and that whole entire sector has been under pressure, they were also hit with a short report in which a firm took a look at some cell phone data for multiple properties in the ARE portfolio and saw the usage was drastically down. And they also made point of the leasing struggles for the REIT moving forward. Since that report on June 20th, the stock hasn't moved all that much, up about 2.5%. The company recently reported their Q2 results, and Alexandria reported $714 million in revenues, which was an 11% increase year over year. The company's top markets saw 15 to 20% increase in demand during the quarter, signaling a potential turnaround in biotech funding. North America reported occupancy of 93.6%, and management said they expect that number to rise to 95% by the end of the year. Now for rental rates, an area that office REITs are seeing lower and lower every quarter. Not the case with Alexandria, as they saw rental rate growth on lease renewals of 16.6%, not really the sign of a slowdown that typical office REITs are seeing. With that being said, analysts are calling for AFFO growth of 7 to 10% each of the next few years. They are looking for AFFO of $7.04 per share in 2023 and $7.51 per share in 2024, which equates to a forward price to AFFO multiple of 16.5 times in 23 and 15.5 times in 2024. Compare these figures to the company's 10-year average multiple of 25 times, and you could see just how cheap the stock looks. Alexandria Real Estate pays a dividend of $4.96 per share, which equates to a dividend yield of 4.1%. The REIT has grown their dividend for 14 consecutive years, and they have a 5-year dividend growth rate of 5%. Similar to American Tower, analysts also rate Alexandria Real Estate a strong buy, with a 12-month price target of $149 per share, implying 28% upside from current levels. Are you new to investing or just looking for some free stocks? Then definitely check out the special promotion being put on by Webull. Right now, if you open a new account and deposit just $100, they will give you up to 12 free stocks that could be valued up to over $30,000. Definitely check out the link down in the description below. So we just took a look at two REITs that I like a lot that are trading at cheap valuations. Now we're going to turn our attention to a REIT I don't like all that much, and I call it my REIT to avoid in today's video, and that is going to be Medical Properties Trust, stock ticker MPW. Medical Properties Trust has been a roller coaster for investors over the past 12 plus months. The company owns, operates, and develops hospitals and medical facilities. The company has also endured a short report very similar to Alexandria Real Estate, but from a different firm. Medical Properties Trust currently has a market cap of $5 billion, and over the past 12 months, shares of MPW are down a staggering 54%. This is a REIT that I've talked about not owning for quite some time. In fact, back in the day, I did own shares of MPW, and thank goodness I got out around the $18 per share price. The thing is, the company owns properties that are a necessity. We need hospitals in this world. But when it comes to owning real estate, it really comes down to your operators or the tenants that you lease to and the locations of your properties. Medical Properties Trust has 444 properties within 10 different countries, so they have a global presence. Those properties are leased out to 55 different operators. Looking here, you can see that the majority of their assets, 64% to be exact, are made up of general acute care hospitals, followed by behavioral health facilities. 70% of the company's revenue comes from its top asset class. When researching a REIT, I always like to look at a company's top tenants. And 99% of the REITs out there these days make it very simple to see the exposure to some of those top tenants. That's not really the case when it comes to medical properties. First, let's take a look at a few examples of what I'm talking about. Here's a look at Realty Income's top tenants based on annualized based rent. Here's a look at Prologis' top tenants based on annualized base rent. And here's a look at Vici's top operators based on annualized rent. 3 different REITs, 3 different industries, one simple to read chart telling me the exposure to top tenants. The reason I do this is the fact that I tend to shy away from REITs that have too much exposure to just one single tenant, or a few single tenants, I should say. Vici's a little bit different because when it comes to casino and gaming operators, there's only a half dozen of the top operators in the world. So that's the case with Vici. But if I were to look at Realty Income's portfolio and see that they had, say, 40% exposure to CVS, even though CVS is a quality company, I would have some doubts there. So now let's flip over to Medical Properties Trust Report, and here's a look at the schedule. You get no schedule of the sorts. What they do instead is list the operators based on total assets. They do list the percentage of revenues, but why not make it simple and provide a total for their top tenant? No, they make you manually add up all the revenues and the exposure rate for their largest tenant, which is Steward, the tenant that many investors have questions about. It's things like this that make me question the authenticity of management. In addition to that, the company also takes equity positions in some of their tenants rather than cash. As a landlord, I want to see cash. The stock has been extremely volatile in 2023. From mid-May to the end of July, the stock moved up 45%. Yes, 45%, and the stock is still down over 50% over the past 12 months. Well, over the course of the past 3 weeks, the stock is down 25%. How's that for a roller coaster? Now let's take a look at the dividend. Medical Properties Trust pays a dividend yield of roughly 15%. If that does not scream red flag, I'm not sure what does. This is a dividend that management continues to stand by. They're trying to say all the right things, but it's likely a dividend that is in need of a cut. Investing in companies with a likely dividend cut is a company I want to avoid. Now let's take a look at valuation. And sometimes when you look at valuation, as we looked at the first 2 stocks or the first 2 REITs, REITs can be cheap, or stocks can be cheap and be a deal, or stocks can be cheap and be cheap for a reason. That's the case with Medical Properties Trust. Analysts expect them to generate AFFO of $1.21 per share in 2023, which would be a 15% decrease from the prior year. And a decrease is also expected in 2024 as well. This has shares of MPW trading at a price to AFFO multiple of just 6.3 times, well below their 13.5 times 10-year average. Put simply, this stock is quite cheap, but I believe it's cheap for a reason, and it's not a REIT that I want to own. So there we just looked at 2 REITs that I believe are high-quality REITs, American Tower and Alexandria Real Estate. And then we turned our focus to a REIT that I don't want to own, a REIT that I want to avoid, which is Medical Properties Trust. I think they have too much exposure to one single tenant, a tenant that don't have all that much faith in, and I don't have that much faith in the company's management team. So that's a reason that I want to avoid it, as I believe we may see, potentially, I'm not calling it, but we could see a dividend cut when it comes to Medical Properties Trust. So down in the comments section below, let me know what you think of Alexandria Real Estate and American Tower, and then what you think of Medical Properties Trust. If you haven't done so yet, make sure you smash that like button down below. Subscribe to the channel, as I truly appreciate it, and we'll see you in the next video. Take care.